Great. Thank you very much, and welcome to this very interesting panel of this afternoon. Let me first of all welcome this highly sophisticated panel. I don't want to introduce all of them because you have the CV and everything, but let me start by introducing the Better Finance and DSW survey on delisting, just as an introduction to the topic of today. I think Ola already mentioned it this afternoon. We asked our members, these are all investor organizations, to explain us the legal frameworks and the recent market practices about delisting in 12 jurisdictions, and then we also included UK and Switzerland. We had a specific look at the three main routes to market exit. First one is the voluntary delisting. The second exit is the restructuring related exit. And the third one is the transaction-based exit, the delisting, which is very often followed by a squeeze-out. The study was published in March of 26, and as mentioned, you can find it on the website of Better Finance. As we all know, listing and delisting are the entry and the exit doors for the public equity markets. Yet only the listing has so far captured policymakers' attention. For years we discussed, and EU policy has focused on facilitating listings, promoting IPOs as a cornerstone of Europe's shift to a market-based financing. Finally, in 2024, the EU Listing Act was adopted, introducing measures to simplify market entry admission procedures and reduce regulatory burdens for issuers. Unfortunately, as of today, we did not see a new wave of IPOs in Europe based on these listing rules. On the contrary, the trend towards delisting continues, and I would like to give you a few data on this delisting phenomenon. Between 2010 and 2022, the EU lost nearly 15% of its listed companies, falling from about 7,400 just over 6,300. Over the recent period, 2019 to 2023, we saw 355 delistings, and in 2023 alone, Euronext registered 110 delistings, which means roughly 467 billion euros in market cap, which was withdrawn from the public markets. We also see this development in Switzerland and the EMEA. And I think if we also in our study had a closer look at what happened with some of the listings and the move of the listings, especially the move of listings into other countries. But the outcome was rather surprising. Only about 130 European companies moved their primary listing to the US, representing roughly 2% of all listed firms and 4% of the total European market cap. So this limited outflow contrasts sharply with the over 1,000 take-private transactions identified over the last years. This confirms the trend. Europe's public markets are shrinking, mainly from the domestic mergers and acquisitions rather than an outward listing exodus to foreign markets. Now, why does it matter for us investors? Well, every delisting shrinks the transparent investable universe available to European savers, and it removes companies from the supervisory and disclosure framework designed to protect investors. And this dynamic runs counter to the ambitions of the CMU and the CIU, which seek to anchor household savings in transparent public markets. Yet the continued rise in delisting, take-private actions and relocations is shrinking altogether the public investment space. In parallel, we see a shift toward private markets as persistently low IPO activities may push more issuers toward private equity and alternative financing routes. So this was just a very brief outcome and introduction to our topic of today. How can Europe deepen capital markets and expand financing options while ensuring retail investors benefit fairly, transparently, and safely? This is more or less our analysis of the current situation, and I have the pleasure to discuss, first of all, this analysis with my dear panelists, and then we would like to cover two main issues. The first issue is, what do we do with these shrinking public markets? What are the measures? What are the solutions? How we can change the situation? And in the second part, we will also cover private market and the role of the retail investor in this private market. So let me start with, first of all, with my honored guest from AFG in France, Delphine de Chaisemartin. I think you also brought some slides, if you want.
Yes, thank you so much.
Not too many, but I think the floor is yours.
Okay. Is there a way to move the slides up?
Yes.
Thank you so much. Thank you very much. Thank you. It's a pleasure, and thank you very much for this opportunity to contribute to this debate. So I'm Delphine de Chaisemartin. I'm Deputy CEO of AFG, French Association of Asset Management in France. I think that it was a thrilling, thrilling to contribute to this discussion because this is at the heart of our future. And for the first time, I think that we are addressing the right question. Addressing the need to rebalance our capital markets, and the urgency of this question cannot be overstated, because we are witnessing today a very troubling trend.
Maybe there?
Yes. So to contribute to this debate, we have to confirm that we have today a shrinking ecosystem. The decrease in IPO and delisting, as you rightly mentioned, reflect a broader structural transformation of capital markets, driven by a high concentration in a few stocks. It's really challenging the efficiency of our capital markets. As you see, IPOs are going down, and as an asset manager, I would have to say that we also observe outflows of small cap funds, which are the primary investors in this small cap. These outflows are really, this is a global chart. So it's not, we don't have here a European problem, it's a global problem. And the same for the number of IPOs. We have the same situation in the United States, you have the same situation in many capital markets. Why is it an issue? In Europe, it means concentration of EU portfolio are accelerating. So the liquidity is concentrating on a few issuers. You see that the investment in EU issuers are shrinking to a very low level at a rapid pace. And there is a high level of concentration on a top 25 issuers. These are figures from the ECB and the sources of Financial Stability Review from 2024. We are in a vicious circle. for small caps, especially. Because what we mentioned is the listing and IPOs are especially hitting small caps. Why are they hitting them? Because the liquidity on the market is already low. If you have a movement of concentration, you have less liquidity, and for small cap, it translates into valuation issues. So low trading volumes translate into less valuation, undervaluation, depressing prices, and then investor divestment, and then fewer dedicated funds, and then low liquidity. So we have this vicious circle that small caps are getting out of the financial markets, the capital markets. One of the other reasons is investor shift. 70% of net inflows in 2025 in Europe went to large cap ETF. And so that also explains the higher concentration in a few mega stocks. Also, as you mentioned rightly, you have the rise of private markets. It is not sure if the rise of private market is the source of the listing or if the delisting is actually bringing about a rise in private market. It's difficult to say which one is actually the first to come. But SMEs become overly dependent on specialized funds, and you have the liquidity risk for investors without listed exit. And finally, you have regulation and cost. We have cost of listing. Small caps also are trading at a discount. And the first panel rightly mentioned, we have to put in place this market integration in Europe package, because if we don't do that, and if we don't fully implement that, we will have lots of this problem. Because the systemic problem requires a systemic response. So the MISP is really important for that. Maybe it is not enough, but it's a first step. And especially to address investment in SMEs in Europe. I'm not going to go into the detail of that, and I will talk about that in the second part. In order to revive IPOs, we launched a few years ago in AFG, together with market participants, an initiative to analyze the source of the listing and to bring about solution. Sorry. Yeah. So one of the solutions was definitely to review, to fight market fragmentation, to increase the fund scale. Also, to avoid regulation which are actually going into the wrong direction. The MISP, unbundling of research cost was a disaster for a small cap. We don't have it yet, but in France we have the benchmark, and the benchmark has bring about delisting of 25% of small cap funds, because they are compared in terms of cost, they are compared to active large cap fund and also to passive management strategies. Therefore, if you look only at the cost, the small cap fees are always considered as outliers. And regarding performance is high, but it has to be looked at with a larger investment horizon. 5 years might not be enough. Another initiative that we've launched is Fund of Fund, which is managed by the Caisse des Dépôts Group in France, which have invested 500 million in funds, in small cap funds. It's a great success. This also bring about more liquidity to the market, and the performance last year was 20%.
Okay, thank you very much, Delphine. I would like to turn to my neighbor, Olivier. Is that right? Did I pronounce it right?
It depends if you're on the English side or okay. French side of the family.
So Olivier,
why don't you choose?
Is that
there you
okay?
go. There you go.
Okay. Olivier comes from the CFA Institute, and I would like to know from his point of view, do you share the analysis we are talking about? And maybe you even have a broader view, because you do not only look at the EU, but also maybe worldwide. What changed over the last years? What is our problem, and where is the trend going? So, Olivier, the floor is yours.
Well, what are our problems? How long do you have? But I would say the numbers are the numbers, right? I know. And Delphine's numbers were, in fact, the correct situation. In other words, public markets, as you could call them, have been in what I would call a secular decline. What is interesting, though, is that this decline has started before MiFID was introduced, right? So as much as we would like to blame regulation on all our woes, we do not necessarily think regulation is the whole story behind the secular and stellar decline of public markets. There is a broader story, perhaps also of changing economic models, business models. We've shifted away from an asset-heavy balance sheet and probably more now towards linear firms oriented towards intellectual property, technology. In other words, those new breeds of entrepreneurs are probably more inclined to not have to share their IP with a broad base of investors, as opposed to a smaller sample of sophisticated investors, institutional investors, that will maintain their IP secret. So there is a whole panoply of reasons why we've seen a secular decline in public markets. It also is absolutely correct. This is not a European phenomenon. It is also true in the US. It is true in Asia, interestingly not so much in China, which is not exactly in the same stage of its development. So the question now becomes, why should we care? And we should care for a number of reasons, right? Including the fact that in Europe, as we know, banking intermediation has usually been the reason why we were able to find funding for the next breed of our entrepreneurs, with lots of regulation on the bank capital requirements side that has now had to shift. Whether it has shifted to the private side is perhaps also what we'll be discussing next. And this is where it poses a little bit of a conundrum for the industry itself, but for regulators, for market commentators. Whose role fundamentally is it to adjudicate how capital gets to be raised? Should we have a point of view on the manner in which capital gets raised? Should we care, for example, if 100%, I'm exaggerating here, but should we care if 100% of capital fundamentally now would get raised on the private side? What does that tell us about typical capital market dynamics? How are we supposed to convince regular individuals, small investors, to engage in capital markets if we're telling them at the same time, however, you don't have access to this side of the market, and even if you do, you will be disadvantaged because of the information asymmetry and the level of conflicts of interest. So there is a conundrum that needs to be resolved here, and I think this conversation will lean into those points later on. Thank you.
Thanks. Let me also welcome our representative from Euronext. Proud to have Jakub Michalik here. And since he's from Euronext, of course, I'm sure that he can give us a clear picture on what is going on in the EU. Why are the European companies leaving public markets, and what can we do to end, and I think Delphine already mentioned it, to end the problem of fragmentation. We are talking about fragmentation now for over 10 years, and of course we hear the German Chancellor saying, yeah, we need one European stock exchange, but the reality looks a little bit different. So very curious to find out, Jakub, what your opinion is.
Yeah, thank you very much, Jella, and it's a pleasure to be here. Thank you for inviting us as Euronext here. There's a lot of things that you put on the table, and I think there's a lot of interesting points that other speakers referred to. So I'll try to share my perspective, also referring to what was said before. So just for you for the audience to be aware, Euronext operates in 8 European countries. We operate 8 regulated markets, 5 CSDs and 2 CCPs. So for us, fragmentation is something we accept because we also thrive on that. But clearly there is a definitely potential to get better. So maybe I will start with giving you a picture which is basically related more on the IPO side rather than the listing. I'm not, obviously your research was based on Euronext numbers. I'm not going to challenge this, but I would like to firstly give a bit of a positive vibe, because it sounded like we do not have any markets and we need European investors. are forced to go abroad, in particular in the US, in order to invest with significant return. So clearly, the picture is not amazing, but it's not terrible either. So just to give you a few numbers, so we had the boom in 2022, and then we have a drop. But then the last years have been pretty okay. So in 2024, we had 72 admissions, with which is basically roughly a third of them is on the main market, and 2/3 is in the venture market or growth market. So this is also something which kind of is mispercepted or misstated in Europe. We tend to look at the blue chips. We tend to look at Magnificent Seven, and we ask ourselves why Spotify went to New York and they didn't stay in Stockholm, and so on. So I think out of 72 admissions 2024, we had 27 on the main market. We still raised 4 billion at the Euronext markets, and over 30 billion aggregated market cap. The year after, so last year, 25, we improved by roughly 15%, so 86 admissions, 32 on the main markets, 53 billion aggregated market cap, and around 1 billion raised. And beginning of this year has been also very strong, and that's not to oversell the benefits of Listing Act and other regulatory frameworks. It's just a trend. People are now in the market crazy about aerospace and defense, and that drives all the listing activity. Since the beginning of this year, we had 16 admissions in the first quarter, 3 on the main markets, 27 aggregated market cap, so 37 billion and 4 billion raised. So we, in the first quarter of this year, raised 4 times more than in the total in 2025. And I think that so that's my first message. The situation is not bad. Doesn't mean that we need to just rest and relax and see whether additional IPOs come. No, of course not. And I think there's a difference between the regulatory measures and the market measures. So maybe starting with public versus private. So for how we see it is, historically, we have had a very strong dominance of the banking sector in Europe. Then the global financial crisis hit. The regulatory response hit the banks. The let's say lending space of the banks dropped temporarily, and there was an alternative of public markets versus private markets. Public markets got hit as well in the regulatory measures. We had very significant regulatory burdens. Firstly, on MiFID, secondly on ESG, and that made public markets less attractive, and the private markets and the private capital kind of put in. But looking on the structure of the markets, there's no competition between public markets and private markets. They are, in our view, very complementary, and we need to arrive in a structure whereby you have a company which grows, which might have started with the bank funding and then moves into the corporate funding line, and then the private equity, venture capital is a natural next step, and the final step is the public markets. And we need to make sure that we create sufficient incentives that the final step is achieved. And what is missing here? So, and this was your question, I believe. So firstly, is the attractive regulatory framework to make listings attractive and also staying public attractive. So regulatory reporting, the implementation of the Listing Act. So Listing Act goes live only in June. So we will really see the benefits, fully fledged benefits in June. There are still a few countries in Europe that have not implemented it. We would very much like to see a full implementation, harmonized implementation across the member states, in particular around the thresholds, about prospectus exemptions, about the English language, about the free float up to 10%. So this regulatory improvements will kick in. The omnibus on the ESG side will kick in. We will also get a stronger push from the measures related to the SIU, related to the retail participation. The second thing is to create a regulatory framework whereby we have a sufficient liquidity in the market. And here we are in a situation where more and more trades in Europe are going to bilateral dark trading. This is not helping
listings. And I have been in the IPO roadshows across Europe, and not only in Euronext countries, because we also try to get listings from other countries. We had the biggest ever defense IPO this January of a Czechoslovak company, which is a Czech company, which listed in Amsterdam. And I hear it all the time with the questions of potential IPO prospects, where will I be traded? And I have to tell them, well, 30% of your shares on average will be traded on the Euronext market and 70% somewhere else. And you would not even know, or you would not even notice this liquidity. So creating a liquidity through the regulatory framework, which I don't want to say incentivize, because we are pro-competition, but at least creates a level playing field between the traditional lead trading venues and the alternative trading venues. The other point, and I think Delphine mentioned it, is the issue of research. This also will change with the Listing Act. We will have the rules around unbundling will change. We expect more research going, especially in the small and medium caps. And I think this is a positive step which I would like to underline. Again, we need to see how it plays out. The last point is in relation to the ecosystem is the role of the retail and the role of the retail that can play into increasing the participation and the trends there, right? And I think here there is a role, and it's not necessarily a European competence, but there's a role for national policymakers and regulators to incentivize the retail trends, not only in order to translate the savings into investments, but translate European savings into European investing. I know there is this tension between fiduciary duty and ensure the highest yield, but let's ensure that people are incentivized, at least they are aware that they can invest in Europe in order to benefit the European strategic autonomy and all those transitions that need to take place. And I think this, with more education and more regulatory measures on national level, we can achieve better outcome than today. Thank you.
Thank you very much, Jakub. Very grateful for the two positive news that I heard. And first of all, it's not as bad as we thought it is. And secondly, yes, we will still expect major improvements by the EU Listing Act in this summer, so I'm very curious to see the reality. But let me turn to our final panelist, Guillaume Prache. He's the current president of Better Finance, and of course I don't have to introduce him to you. He is the representative of all the individual investors. And Guillaume, curious to find out, do you share this analysis that we discussed so far? And what can we do to revive the equity market in the EU?
Good afternoon, everyone. And thank you, Jella, for including individual investors. So individual non-professional investors, we are called retail investors. It's a marketing category, but that's who we represent. It's quite, I think, a very timely topic. I am at the ESMA stakeholder group. Tomorrow we are discussing a stakeholder group paper on how to revive IPOs in the EU. So it's quite on target. And to refer to the previous question at the previous panel, I'm the only retail investor participant in this working group, but rightly so, there are a lot of issuers, because when you want to, because yes, so to answer very quickly your question, yeah, I think the situation is not good overall, even if Jakub had some good news for us, because the listings, you gave the figures, small cap funds, Delphine gave the figures, and when you compare this to when you compare the amounts, the market caps, the funds raised compared to the US, it's appalling, huh? And it's going down. I mean, okay, there is a little hope, at least at Euronext, but it is not going up strongly as it should for the SIU, for the, I heard the previous panel, the competitiveness of Europe. So there are tens, if not hundreds, of proposals to fix the problem. There is a German-French Ministry of Finance report, recent Cookies Noyer report, or 5 report, which lists, I don't know how many proposals. But so we need to attract issuers and investors. Issuers, they need, indeed, it was said by several participants, they need liquidity and they need a lot of potential of gathering funding. If not, yes, they will go on the Nasdaq where there is a much bigger pool of liquidity. And for individual investors, they need to be attracted by small and mid caps, especially. How do you do that? The key problem identified by this working group in ESMA, but also identified 2 days ago by the chair of ESMA, being heard by the European Parliament, fragmentation. Fragmentation, that's how you don't get the liquidity. And it goes both ways. So it's detrimental and a deterrent for issuers or potential issuers, but it is also a problem for retail investors, because retail investors, they have the money. The saving rate in Europe is very big, but they don't have easy access, easy tool to do that. So among the tens of proposals I've seen, as we have only limited time in this panel, I think 2 can be game changers. The first one is, I read in this Franco-German official report, is the creation of a European innovation market to facilitate a concentration of the capital available in growth-oriented listing segment. It's exactly what we were talking about. We need to have a bigger, combined, concentrated, consolidated pool of capital. They are not very detailed on this, and this would be more a question to the specialists, especially the European securities exchanges, where Euronext is represented here, how to achieve that. But definitely, I agree with Jakub that this should be, for targeting retail investor funds, should be a lit venue, really public market. The second one, I think you have the slide there. Yeah. So this is the access, the technicality, how to make sure, for example, I don't know, Estonian opportunity, for example, of a new small cap can be easily accessible to this huge pool of funding, which is the mass retail savings in Europe for, I don't know, a Portuguese retail investor or Greek or whatever. So I've been working in the US in the past, and it's good to have, of course, directly involved individuals in the stock markets, including in the small and mid-cap markets. But this, whatever you do, sorry to be blunt on the literacy, first it will take decades, and second, it will remain a minority of the overall savers, because many savers, they prefer to have a professional give him access and give him a product that does that. There is that in the US, and I give you an example here. To get mass retail money, I'm talking mass retail money, and you will see the figure here, into publicly traded stocks, including small and mid-cap or very small. So we research at Better Finance the two biggest index funds invested in the broad index. Broad index meaning including as much as possible. It's also called total market indices, as much as possible, mid and small caps. The biggest we found in the US is called Total Stock Market. It's invested in 3,700 US companies. The smallest they invest in is $15 million market cap, so maybe 13 million euros. Very small, it's micro cap. And it has collected 2.1 trillion US dollars. It is mass retail money. coming partly, very easily, to small and mid caps. Personally, I have my IRA in the US. I have 100% on this. As you can see, the next to bottom line, I am not too unhappy with this retirement investment. In Europe, the biggest we found, it's 18 billion market cap. And the broadest index we found that funds invest in, or significantly, it's the Stocks Europe 600. So I'm happy to say to Delphine that Stocks Europe 600 is a European index provider, not American. It invests only in European stocks, and the manager is European as well. I think he's a member, in fact, of AFG, the French investment association. The problem is, it is not that broad an index. It's only 600 companies. The smallest market cap in this index is 1.6 billion. I'm sorry, this is not a small cap. It's barely a mid cap or a large mid cap. So that doesn't direct flows to small and mid cap what we want to do. And it gathered 18 billion, so it's less than 100 times less than this US fund, and doesn't touch small cap. So it could be a huge opportunity. We have developed the details of this and how to do that. And it's quite simple, and we are not asking for regulation. It's quite simple to do, but you need, of course, political will and people understanding the interest of such mass retail product that could bring more rapidly than enhancing financial literacy, but more rapidly a lot of funds to the small and mid-cap market. Thank you.
I think, Jakub, you want to comment on Guillaume's...
Yeah, thank you. So no, because I realized that I have invertedly dodged one of the questions that you asked as well, but Guillaume kind of reminded me because he mentioned the joint Noyer cookies report, and I think the report is very good. It points to the interesting topics, but there's one element which is not good, and you mentioned it, Guillaume, is related to the 28 regime or a European Nasdaq, and no offense to Nasdaq colleagues who are in the audience. The reality is that we have a liquidity problem, and we need to fix this liquidity problem through two measures, right? For the larger retail and pension fund participation, and by the trend towards bilateralization. What the 28 or dedicated the European Nasdaq or European startup exchange will fragment the liquidity even further. So
I'm not referring to that proposal.
Yeah,
it's another proposal.
Yeah, but I just wanted to clarify that because it sounds nice. It sounds like something which we would like to develop and compete, but the market reality is that the market would be even more fragmented. So I would rather work with other exchanges in Europe in order to deepen the liquidity. We might think about the ways how we are smarter in competing, where we can think about consolidation measures for market-driven initiatives, and we have been doing quite a few over the last years, but creating a new segment on the European level as a 28 regime for trading is not something which will fly in the practical terms.
Okay. Yeah, very good. Delphine, I think we should discuss in detail what your proposals are to change the situation and how can we mobilize the investors.
Yeah, thank you so much. To rebound on this slide, I'd like to say that index funds are great for retail investors, as you mentioned, because they are easy to invest in. But they're not making the market. They are replicate the market. So before we go to that step of having a market we can replicate in Europe with a large liquidity, large volumes on small cap, we need market. We need primary market. So we need IPOs, and we need also managers who invest in financial analysis and research, and actively manage and actively invest in the market. Passive management is great for secondary liquidity, but it is not building a market, it's only replicating. So that was the first one. And for the second point, I mean, it's great that we have a large European asset management managers still in Europe. We have 6 actually in Europe, 6 asset managers still among the 20 largest in the world. So this is great because it's a great tool, and it's important for our European sovereignty and making sure that we can still have some investors that apply the European regulation. Regarding the solutions, I fully agree with Guillaume on the fact that, and with others, that private market cannot replace public market, and especially for retail investors. They are complementary, and I think you mentioned that also. They are interesting in terms of diversification, but that very difficult to access for retail investors. So we are in favor of having a small size of private markets and private assets in our funds. And for instance, in UCITS funds, we have a 10% of this fund which can be allocated more to private assets, and we think that would be interesting to have this openness. But of course, we have to be very careful because private market presents some issues for retail investors in terms of liquidity, in terms of valuation uncertainty, and in terms of regulatory protection there are some differences. So we have to be careful with that. And so the main target will be, I would say, developing private market. That's a good point, but we have still to revive, the public markets and revive IPOs. And you say it's on track. A lot of measures have already been taken. I also fully agree with that. That with listing height, we are going in the right direction. But we still have to incentivize, as you mentioned, also investors to invest in Europe. 30% of equity funds invested in Europe, it's a bit low, and I'm mentioning the EMEA figures from last year. Only 30% of investment are made in Europe. We can, and in compliance with the fiduciary duty, we can do a bit more. We can do a bit better than 30%. And the 30% is just the last figure because it's not going up. So I think that, for instance, the Finance Europe label is a good initiative. It's not mandatory. Everyone, can, decide to invest or not invest in a Finance Europe label, but it gives some visibility to people. The second point is investing long-term. If you have a long-term investment, if you have pension funds, then you have the time to invest more in equities. And that's important because equities are much more risky, more volatile. Therefore, you need more time. And incentivize in Europe the development of pension funds and long-term savings plan is really, I think, a good thing. And of course, financial education is key. It has been mentioned in the last panel. We have to get investors in Europe more informed, well-informed of the choices that they are making. They have a short-term view. Most of the time, they are going too much into very liquid and very secure savings. They can take a bit more risk if they want to get more returns and especially build on their future.
Thank you, Delphine. I think we should stick to the public market first. And Olivier, I would like to hear your view. Where do you see incentives for investors to go into the capital markets? And how can we increase the number of IPOs? What would be your proposals?
I don't know if you can, basically. In other words, the market will go where the market finds it efficient to raise capital. And the question is whether there is a level of friction right now in the market that is causing a deficient access to public IPOs. It's difficult to determine whether that is actually the case. So I'm not sure. We've never actually tried to find ways that would actually result in a heightened level of IPOs in public markets because, first of all, as we've said earlier, this is a secular trend. You would be hard-pressed to argue that Sarbanes-Oxley in the US is less harsh than the disclosure rules that we have in Europe. Yet, the US is also going through a secular decline of IPOs. So the question is rather, as opposed to either or, the question is probably allowing better access to all of the above and ensuring that proper disclosures allow for information to free flow where it needs to be for people to make informed decision. But policy mandates, incentives, they usually have a double-edged sword, because if you try to provide incentive in one corner, you're going to decentivize another corner of the industry, which is probably not something that you actually wanted to achieve. So it's a very, I'm sorry to say, it's a very European perspective that you can channel flows of capital where you want it, that you can engineer capital markets to result in the flows that you're looking for. This is probably not the perspective that we take on that question at CFA Institute. However, the problem of SME funding remains absolutely correct. There are a number of initiatives in the EU that we have supported, including the launch of LTIF's version 2, which is proving rather popular with investors. It's still rather small, about 35 billion euros, if I'm correct, 270 fund, which means the average fund is quite small. We remain of the view that intermediation, when it comes to providing investors with the right level of advice, is probably the right way forward. We've been discussing in Europe now for a long time the development of portable pension products across the EU. And when you have a fiduciary that interfaces the decision on someone else to invest their money, aiming for long-term perspective, this is where a broader portfolio could start making sense. In other words, you're not simply investing in capital markets for the short term, you're investing with a broader perspective to satisfy your longer term financial security, where real estate, infrastructure, private equity can start making sense. Now, I think Jakub made an interesting point earlier, which is that the way that we always thought that the dynamic between private and public should work would be to look at it in a sequence. A young company should have access to flexible capital through venture capital, and then you find the next stepping stone in more middle market private equity, and eventually you go to an IPO where the rest of the market gets the benefit from that. The problem is also the perception that perhaps maybe most of the value has actually been generated on the private side before it reaches public markets. You're going to struggle with convincing people that investing in private equity in this context means they continue to have access to I would say, a decent share of the value creation. So I'm not sure the question is really how can we attract IPOs. Most governments in the world now are engaging in a race to the bottom precisely to attract IPOs by deregulating disclosures, which is definitely not something that we are in favor of. In fact, there is no demonstration. In the US right now, you've seen the debates on semi-annual versus quarterly reporting. There is no evidence, as in the UK, that going from quarterly to semi-annual has resulted in more IPOs, for example. So the notion that there is a lever that you can activate simply to attract IPOs, I think for us is a little bit a simplistic view of the situation.
Before I give the floor to Jakub again, I would like to turn to the point of the pension systems in Europe. We have a gap there, and if we look at the German system, I think it's a very good example. We have a major problem in Germany with our pensions. So the new government introduced a follow-up to the Riester-Rente, and it's now possible from 1st of January 27 to choose a no-guarantee product, for example, an ETF with limited costs. And this is being tax incentivized. And for us in Germany, this is quite a revolution because we didn't have that before. Of course, we can say it's not a direct investment in shares, it's only ETF. But what do you think? And I would be interested in all of your opinion. Jakub, maybe you can start. Is this kind of a booster for the capital market, or is this something we should not consider?
No, thanks, Jella. Before I speak about pension, actually, I wanted to respond to Olivier, because I don't think I agree with, firstly, with the regulatory trend, that it's a race to the bottom in terms of regulatory requirements, in terms of what's put in the prospectus and is put in the private, like in the public domain. I see two trends. Firstly, I do see a trend in terms of political support to potential IPOs, and we are competing. So just for you to understand, our complete market cap of all Euronext markets in terms of listed companies is 6.8 trillion euros. Might be a bit better today because the market rallied. But it's around, let's say 6.8. This is twice the size of the London market. And London used to be the financial center of the European Union before they decided to be the main financial center of the United Kingdom. So it's clear that we are competing with more liquidity against companies that might list in London as well. And we do see the political, activity, Rachel Reeves will show up to the IPO roadshow on the very early stage, and FCA would be faster than they used to be in approval of the prospectus. But the content of the prospectus has not really been emptied. The second point on elimination of the quarterly reporting, that's a simplification that Europe has gone already a few years back, but in practical terms, it has not changed much for the companies who are seeking the research. Euronext is a CAC 40 company. We have not given up our quarterly reporting because this is what our investors and analysts require. But there will be companies who have given it up and they save money, and maybe this is a deal breaker for them to stay as a listed company or the list. On the pensions, well, absolutely, this is something which is extremely important for Europe to grow. We have been living, and this is a personal comment, we have been living in a dream that let's say my parents, also a few generations back, were given, that if you work and then you turn 60, you became a state pension and you will have a nice life till the end of your days.
I still want to believe them.
Well, state pension.
I stopped believing in that, and I think the sooner the wider society realizes this, the better it will be for them and also for the European capital markets. That's the first point. The second point is we do need to shift the pension funds investments towards more equity. We need to embrace the equity culture. If you read the Draghi report and you don't go into the details, the main message is there: we need to create a European equity culture, whether it's on the supply side or on the demand side. We have to stop giving tax incentives to retail bond offerings. We should stop. I mean, it's great that Italian families invest in BTPs, but it does not deliver on the Draghi report, and therefore, not only building the pension systems as it has been done in Sweden, in Denmark, in Netherlands, in other countries, but making the pension system actively playing in the equity market, that's the way forward. Thank you.
Let me maybe turn to our second major topic, and that's the private market. We don't want to forget about this. And I think you said, Delphine, it's also a chance because you have diversification. But what happens if retail investors really go into the private markets? And I go myself, I turn myself to Guillaume Prache, and I would like to know, where do you see the risk for retail investors, and why is it so difficult for individual investors to go into the private markets compared to the public markets?
Yeah, but first let me say that as individual investors, we have nothing against private equity. It can be a good diversification for those who have a minimum size of portfolio and a minimum appetite of risk. But we have to realize, and I think that was said by Delphine earlier, but first, it's complementary to public market funding. Second, it is and should remain a small part of the funding provided by retail investors. I'm not talking about professional investors or institutional investors. You were mentioning the retirement system. One big problem identified by Draghi, Letta, other reports is the misallocation of funds, and Jakub just referred to it, by institutional investors, European institutional investors, pension fund insurers. I give you the ballpark figures. European insurers, 80% in bonds, in fixed income. European pension funds, IORPs in the European jargon, 50-60% in bonds. When you look on the other side of the ocean, for example, if I take just the IRA, the individual retirement account of people, not professional investors, 67% in equity. 67% in equity. And also when I look at European institutional investors, to go back to your question on private equity, it's smaller than what the French government is requesting individual retirement savers in France to put on private equity. If you are the basic, the default option from the French individual retirement plan, you have to put 8% minimum in private equity. But professional investors are much below that, and although they have much more expertise. Because private equity, why should it remain low? Again, nothing against it per se, for retail investors, is that you don't have the transparency, you don't have the investor protection rules of public markets, and you have two other issues that are not always mentioned. You have a valuation problem. In public markets, by definition, the pricing is made by the market. In a private equity fund, the valuation is made by the manager. Tells you, yeah, but that's worth this. Thanks, but then when you will only know if it's true or not when the assets, the underlying investments are being divested, if they can. And the last problem with private equity is that there is an AMF, the French regulator report from last year, which shows a very big difference of returns between professional private equity and retail private equity funds. They were sold, for example, to French people by saying about private equity, super, last 10 years, 15%, 13% return per year. AMF comes with the report. We had asked for this report, but yeah, but what about the private equity retail funds that are sold to the retail, that are within this 8% minimum the retirement saver has to invest in? 2-3% nominal, and maybe not all costs included. Of course, that's historical returns. They are not a good indicator of future returns. Nevertheless, it is not the double-digit returns that were asked for. So nothing against private equity, but for retail investors now, and I seize the opportunity with the Commissioner listening, LTIF2 has lowered the minimum investment for retail investors to 0, and whatever their portfolio is. But de facto, when a retail investor would like to invest in investment-grade bond, much less risky, okay, but be a bit less useful for innovation, although companies need also bond funding, de facto it's 100,000 euros minimum that you have to put. So there is no retail investment in public bonds. It's much easier to go to LTIFs, but the risks, of course, are quite different.
Thank you very much. Warm welcome to the EU Commissioner, Maria Albuquerque. And I think that is the moment where we should close our discussion. But of course, I give each of you the opportunity in front of the EU Commissioner to say one wish that you would like to see from the EU Commission in 1 minute, and then we could close the discussion. Jakub, you want to start?
Yeah, thank you. I'll be very quick. The conclusion of MISP negotiations as requested by the European Council by end of the year.
Okay, thank you.
We are supporting the market integration and supervision package. And as I mentioned earlier, I think that it has to be implemented as a whole package. And we have to be careful about cherry picking. We have a systemic situation to solve in financial markets in Europe, and we need systemic solutions and not, measures and do cherry picking on that. So also we are not fully agree with everything. We think that it has to be implemented as a whole.
Olivier, take your chance.
Right. I would say reconciling investors in Europe with capital markets should be our ultimate objective here. And the way that you do this is in determining how engaging in capital markets is the only way that you're going to secure your long-term financial security. Going back to the point made by Jakub earlier, I think this is absolutely of the essence. And so a little bit of all of the above, as opposed to trying very hard to channel capital where we want it to go, allow people to make informed decisions by ensuring that we have the right level of disclosures, that they understand the fees, and that they can connect their investment with the economy that they wish to support through this investment. So it's a non-answer to your question, but I would say our objective should very much be to reconcile people with capital markets.
Guillaume, final remark to you.
Yes, well, we also strongly support the market integration package and supervision package, so another acronym, MISM. But given especially what Draghi and Letta said, which is at the origin, in fact, of this priority of the European Union, of the Savings and Investment Union, it's high noon for the competitivity of Europe, and we would like to see even bolder measures to achieve as quickly as possible some tangible results, strong results, other than financial literacy, which will take some time to bear fruit. So, and I picked two during this panel, is one in the Cookies Noyer report, which is the pan-European innovation market, to consolidate funding capital for this key segment of our European economy. That's different from the 20th regime proposal that is also in this report. And one thing that doesn't need any regulation and any public money is this the total European stock market mass retail fund. Let's do like the US, let's gather 2.1 trillion euros into that fund, and that would certainly help.
Let's be a federation.
Let me say thank you to this very interesting panel and the discussion we had, and we're looking forward to listen to you. Thank you very much.